Uh, the the spreads are basically here. I'll give you an example. Now, remember, if you're selling an option, you're going to be selling an option at the bid price. Let's just take these calls for a second on the IWM. When you purchase a call, you're going to buy it at the ask price. If you're selling an option, you're going to sell it at the bid price. So if we're doing a spread, let's say we want to do a very simple, what was the first, let me take the most basic and simple spread order that you can possibly take. And really, this particular spread, called a vertical spread, is probably the basis of almost every single option trade that you'll ever make, because they're based on this one type of spread, the vertical spread. Almost all the other spreads that we use, including iron condors, calendars, and double calendars, and even double diagonals and some other sophisticated trades, including back ratio spreads, are all just a variation on the vertical spread. So, for example, now we can simply, in the Thinkorswim platform, we can simply right-click on these and go to Buy Vertical. And that will give us our vertical spread. But before I do that, I want to show you exactly what it means to buy a vertical spread. Let's say we're bullish on this particular index, the IWM, and we believe it's going to go up in price. We have a couple of different options available to us. No pun intended there. First, we can purchase an outright call, and you can see as I hover my mouse over this $1.98 price call, which is the June 72 call, I can simply left click on that and it automatically brings up the order entry box purchasing one of the June 2008. That's the date it expires, in June of 2008. The strike price is 72. It's a call, which means that we will profit if the underlying index goes up in price, for $1.98, which is the current price. And it's a limit order. In other words, it's an order that we don't want to pay more than $1.98. Now, if you can set all kinds of different orders here. You can set market, limit. If you select market and you submit that as an order, if that price changes to like $3 all of a sudden, like 2 seconds, well, you're going to pay $3 for that. So I always enter my orders as limits. I want to see if I can get it at that particular price. And if I can't, then I can always change my order, but I don't want to pay more than $1.98. And that limits me to the amount that I actually pay when I submit that order. And you can submit this order for the day. You can submit it good till canceled. In other words, if you submit an order to purchase this June 72 call, one of these at $1.98, and you select day, that means that they will try to get you that price the entire day until the market closes. If the market doesn't give you that price, then the order automatically expires at the end of the trading day, and you won't have that order in the very next day. It will cancel. It will just be over. They'll terminate the order, and you'd have to order if you wanted to continue to purchase that option the very next day. You'd have to put the order in again. But you can also submit your order as GTC, or good till canceled. And that means that when you submit this order, and we'll just click OK here, it changes to, instead of a day order, it changes to good till canceled. That means that this order will stay on the brokerage firm's computers and will be executed at any time today, tomorrow, a week from now, or even 2 weeks from now until this option expires for $1.98. Generally, I don't like to do those kind of orders because they're just too long for me. Normally, I do day orders. But you also have the option, I guess, of doing an extended hours order. But normally, those are only during extended hours. I normally go with day, and the reason is normally if I put in an order for this particular option and within 5 minutes I don't get filled at the price I want, I cancel the order. I don't like to hold that order for more than a few minutes. The reason is that the market can change dramatically. Maybe I can get it at a lower price. But normally if you're just buying or selling a single order, the reason that that there's an asking price here of $1.98 is that the market makers have quoted this as a price in which they will sell this option for $1.98. If they were not willing to sell it at $1.98, they would not have a quote of $1.98 here. So on a single option order, you can submit this, and as long as the price doesn't move dramatically, they will fill that order instantly at $1.98. Now, on some options, you can actually ask for a mid-price order. Now, this is during the weekend after the markets are closed, and the bid and ask are a little bit farther apart than they normally are on the IWM. Usually, they're like a penny or 2 cents apart. So normally you're going to buy at the asking price, and you're going to sell at the bid price, and there's nothing in the middle of that. There's no mid-price on single options. But I mean, you could go down if they did have a wide enough spread. You could go down maybe a penny. You can see what I did here. The platform of TOS always shows what the natural price is and what the mid price is. So you could try to split the price and get it down to $1.97 or even $1.96, which is the middle price between the $1.94 bid and the $1.98 ask.